talk was advertised as accounting for risk. You'll notice I've used the title here, accounting for uncertainty. We all understand there's a difference here. I like the word uncertainty because that's how the accountants talk about it. If we had time, we could actually talk about the difference, but that's not important for the talk. Here we go. Okay. So what I'm going to do is report on research that I've been involved in the last several years with others, both some theoretical aspects to it, which may have more interest to you all, and empirical aspects. The sort of layout of the sort of the state of the art of this research is in a monograph which has just been published by Accounting Foundations and Trends in Accounting, which you can dive into if in fact if I pique your interest. I do hope to pique your interest because this has been a rather lonely endeavor of myself and a few other co-authors, but I think it's a very important endeavor, and I think there's a lot of avenues to go in this area, not just in terms of valuation, not just in terms of risk revelation, but also in accounting policy, which I'll indicate as we proceed. And man, do we need theorists? I'm not a theorist, so I come to you today a little bit fearful, okay, and hoping to learn something from you. But I think I have some ideas, and I've worked with some capable theorists in the area. So that's what we're going to do now. This is in the context here of the financial reporting objective of the FASB and IASB. One of their objectives, or the primary objective, I think, is to provide information to investors about both the amount, timing, and the uncertainty of future cash flows. And you'll see that I've got uncertainty italicized there because that's the aspect I'm interested in. I don't think there's a lot of work about accounting communicating that uncertainty. Now, so the question is, now what is accounting? What is the accounting that actually gives you this revelation about this uncertainty about future cash flows? This is a narrow objective too, and many of you may work in terms of other objectives of a financial reporting system. So it's a narrow focus, but I want to appreciate that we are within that narrow focus here. Okay, and largely it's risk, a question of risk for investors, and that brings us to sort of the standard valuation research in accounting. Okay, on valuation, the big instruments, impetus to this was the revival, I guess, of the residual income model by Olson in 1995. But of course, it goes back much earlier than that, to the early part of the century, or the last century. And we understand that given clean surplus accounting, you can substitute earnings and book values for dividends. Okay, and this is what you get: the values based, the book value with added values from predicted earnings in excess of the required return on the book value. This was a great boom to our research because it got us out of this wretched, repetitive capital market research of running regressions on prices on returns, but not really getting prices on accounting numbers, but not getting any real identification. But I've come to realize that this is an empty model. You as theorists understand that merely substituting something for something else is not a theoretical model. Okay. It puts nothing on the table. So there's nothing here unless you specify how the earnings and book values are going to be constructed, how they're going to be measured. And that's really sort of I think that's in valuation, that's the task, our task to think about that. Actually, random numbers satisfy this expression, and it only works because in the end, as the dividends are paid out, in the liquidating dividend, you've got to have earnings measured such that the book value goes to zero in the terminal dividend. Anything up to that point can be just a random number, okay, with the settling up in the liquidating period. The other aspect, of course, is that nothing is said about the discount rate. And so most of our valuation work has been based upon the numerator. But we said nothing of the denominator. So if I teach this class, if I taught this class, I say, well, get your spreadsheets out, model your future sales and profit margins, get some estimates of these forward numbers. But I can't tell you anything about the R. Okay, go over to your finance professor. Maybe he or she can do it. The best of luck, however, because don't think you're going to find it over there. So that's the context of this. And the question is whether to the extent in the literature we've dealt with these issues. Now, by the way, my idea here is just to give you the flavor, the overview of what's going on in this research, okay? It's not a presentation of a specific paper. It's to give you the flavor, the overview, where it's coming from and where hopefully it is going, okay? So this is, it's sort of 30,000 feet, I guess you call them, okay? But the question is, to what extent have we dealt with these issues? Well, of course, the Olson paper was the one who revived this residual income formula of Piesnel and Preinrich and many other scholars. And he actually introduces accounting, okay? He does so by assuming a linear information autoregressive process for the accounting numbers, residual earnings, okay? And that's very helpful to a theorist because you get closed form solutions, you get to certain propositions. But those linear information dynamics in the parameters that drive that process, that autoregressive process, is embedded the accounting. Okay, it's the accounting that determines that process. And so, for example, in mark-to-market fair value accounting, the parameter is very different than if you have historical cost accounting or a form of historical cost accounting. But is that how accounting evolves under the accounting principles that we have today? And are those the principles we want to satisfy the practical valuation demands of an investor? The Olson model, the discount rate is the risk-free rate, okay? And people say, oh, Olson, I can't have the risk-free rate in there. Well, of course, it's there because he is saying, hey, listen, folks, this is nothing to do with the denominator. This has nothing to do with the cost of capital. So I'm just going to set it at the risk-free rate, okay? So that issue is completely completely suppressed. In the Feldman-Olson paper, they bring in conservative accounting. And actually, it's conservative accounting that, as you work through it, produces an evolution of accounting numbers, which is inconsistent with an autoregressive process. But they do it by a formal conservative accounting, but they maintain the same linear information dynamics. The other one another paper that's trying to deal with this is the Voltanahu paper, in finance, built on the Campbell-Schiller models, where they now use the clean surplus relation to substitute earnings accounting numbers for dividends in a dividend discount model. And the two variables they come up with are rate of return on equity, ROE, and book to price. And again, they apply an autoregressive process. Very nice, because you get closed form solution, and we like, or you like, and we like as a theorist to get closed form solutions, okay? But of course, they depend upon your assumptions. And I hope I can sort of show you that the autoregressive process is not consistent with the way the accounting, under the accounting that I'm going to talk about, that reveals risk. And the R, if you wish, how it works. The other thing about the Voltanahu model is that ROE and book to price, as we all know, are dividend dependent. Payout affects both of them, and so you have a model which is actually inconsistent with M&M. Okay, it's not dividend irrelevant. It's driven by dividends in part. So, and in accounting research, people have picked this up, the Voltanahu model. Jeff Cullen and Matt Lyle at Northwestern, Wang at, he's at Harvard, isn't he? They've done model, and they've got very elegant models, which actually not only give you R, but sort of give you a time series forecast or a term structure on R, making these assumptions. This is the background, and this is really the point of departure, okay? So here's the agenda that we are engaged with. Specifying the accounting for practical investing, okay? It could be fair value accounting, okay? or it could be historical cost accounting or some form of historical cost accounting or anything you want to nominate other than random numbers. But can it also inform about the discount rate? If you get an accounting which actually informs about the numerator and the valuation and the denominator, gives you insights into the denominator, then you have a comprehensive accounting for valuation, because the valuation is based on the numerator and the denominator in a valuation model. This is the agenda and the call to research. Again, as Jeremy said, please interrupt me at any time. Basically, I'm trying to explain what's going on here. Okay, so I want to introduce some accounting principles for measuring earnings and book values. Now, we're in accrual accounting, and accrual accounting says it's different from cash accounting, because cash accounting just has cash inflows and outflows, and only one account on the balance sheet, the cash account. This is how you do your accounting for your tennis club or the US government. But accrual accounting, of course, we say, well, we recognize that earnings are different from cash flows. And correspondingly, we generate a balance sheet in addition to the cash account. And of course, we recognize from the cash to cash cycle that total cash flows over the life of the business are equal to total earnings. But in specific periods, we recognize earnings as different from cash flows. And so the heart of the issue is, what is the basic principle for reckoning earnings that are different from the cash flows? And about 15 years, I remembered something my accounting professor said back in, I got to admit, the 1960s, okay, in my first accounting course. He said this: the basic principle governing the recognition of earnings under accrual accounting is in red on the screen. Under uncertainty, earnings are not recognized until the uncertainty has been largely resolved. You may, in your price, estimate a price for Telsa, which anticipates future earnings, and of course you should. But the accountant says, we are not going to recognize those earnings until we get the resolution of uncertainty. It came back to me strongly. And I actually, if anyone disagrees with this, I actually think this is the governing principle, okay? Before that time, expected earnings are at risk, okay? They're not yet realized. Now, of course, I'm talking about historical cost accounting, where you wait until you get the resolution uncertainty, until you recognize earnings. And of course, it's then you add to the balance sheet under the clean surplus relation, under the articulate double entry. Fair value accounting, of course, violates this because it puts all the future into the balance sheet, and you wait for the balance sheet to crash as you get the resolution of uncertainty. Okay, now I'm going to move quickly here because I only have half an hour, and I really want to hear your comments and your questions and your challenges. There's two aspects to us in earnings. There's a revenue line and there's an expense line. And I think we're familiar that we only recognize revenue when it's realized. That is, you got to get a customer. You got to grab a customer, a right to send the bailiff around, and that certain conditions have to be satisfied. This is under the new Revenue Recognition Standard 606 and IFRS 15. Contract has to be completed completely on both sides, and receipt of cash is highly certain. We recognize the revenue, we don't have the cash, but then what we do is say, well, hold it. Not worried, still a bit worried, there's still risk. So we discount the receivable with a bad debt allowance to get the cash equivalent. So that's embedded in the accounting in the standards we do now. Now, I'm not maintaining this is the appropriate accounting for risk, and I'm indicating one system of accounting which actually responds to risk. And I actually think GAAP accounting, IFRS accounting, is a system like that. I'm sure it doesn't do it perfectly, which leads open the question of whether we can actually prove on this risk revelation, which I'm going to talk about. Now, my professor, I remember came back saying, well, hey, listen, you recognize the revenues and then you match the expenses. Well, you match the cost of goods and the cost of the goods of the inventory you shipped out to get a gross margin. That's matching. And then you calculate some depreciation, that's matching. And I come to realize that he's actually, that goes on. There is, but actually there's some very deliberate mismatching. That is when investment is particularly uncertain or risky, we don't put it on the balance sheet. We expense back at the income statement. Of course, that's mismatching. It's not expenses to generate current revenue, it's investment to generate future revenues. A very deliberate mismatching. People maintain that the information content of earnings will decline because it's less, because of increased mismatching. I'm not sure about that. And here are the basic references. The conceptual framework says an asset is something the future benefits, but don't go and book it if there's a lot of uncertainty. Don't book it to the balance sheet. We know FASB statement number 2 under R&D. We know IAS 38, where we distinguish between research and D in terms of what goes on the balance sheet. And it's all on the basis of the probability uncertainty of future benefits. Even ISS 18 property, plant and equipment says, don't put on the balance sheet unless the benefits are probable. Okay, so clearly there's an admission of uncertainty here. A loose, you might say, loose criterion to deal with uncertainty. So that's there are two accounting principles for revenues and expenses which go in the income statement, which govern the booking the booking of earnings. Okay. So and here are, in the modern corporation, they say these impact investments are, Apple doesn't build factories. The people in Chengdu build factories. They have R&D, advertising, human capital, software, expenditures on all these other things. Okay, they get expensed immediately. Now, whether GAAP and IFRS do this precisely to reveal risk is another question, of course. But in principle, that is under the standards. That's what's going on. Okay. So, what I'm going to do now, recognizing that accounting, and that there is accounting that is risk revealing, I'm going to do two things. First of all, I'm going to look at some empirical evidence on this accounting. And secondly, probably of more relevance to you, I'm going to look at the theory, okay, that ties this accounting to, let's call it priced risk. So, first, empirical evidence, I'll move on very quickly. This is just flashcard time, okay? It's investment book to the balance sheet, investment book expense to the income statement is priced with a risk premium. The evidence shows that investment book to the balance sheet is priced $1.30 per dollar of investment. The historical cost goes on the balance sheet. The market, on average, values at $1.30. That is, it says there's expected value added here, okay? And you look at that mentioned the income statement, R&D, for example, it's only 0.65. Okay, there's a strong discount here. Okay, and the market says, "Well, man, you're doing research to get a cure for pancreatic cancer, but oh man, it's risky, and we're not going to price it like you've got inventory or property, plant, and equipment on the balance sheet that's producing that inventory. We're going to discount it for risk." Another paper says, look, if you look at IFRS, where you can capitalize D, but not R on the balance sheet. There's a paper here by Oswald, Simpson, and Zara wanted to say, look, they could look at it and say, look, R&D that's deemed successful is priced with a premium of 2% of R&D investment that are not yet deemed successful. So the market does, in fact, differentiate investment book to the balance sheet and investment actually charged against earnings. Accounting numbers that are under these principles predict forward stock returns. Okay, I'll just leave the references to the papers at the bottom of the slides here and indicate just results. These are empirical results. So you actually get these numbers which actually are determined by, so low earnings depressed by expense investment, that predicts stock returns. Now, of course, that could be the market's inefficient. But if in fact, under a main assumption of market efficiency, evidence of average stock returns are interpreted as reward for risk. Okay, and actually, in this 2014 paper here, we show that actually, all these anomalies, accruals, book to price, earnings to price, growth in assets, these are all explained by the accounting for determining these assets. Mm-hmm. And these anomalies are actually not anomalies, but consistent with the accounting principles determining numbers which actually convey risk. Accounting numbers and risk. Well, as well as forecasting returns, yielding expected returns, these numbers predict betas. You'll notice I got forward in italics here, because the beta that investors are interested in are not the historical betas. They're the forward betas out of sample, which in fact they're going to experience during their investment period, and it predicts those betas. It predicts the variance of returns. It predicts the kurtosis of returns, both in stocks and in portfolios. This is quite suggestive. Okay, we never of course judge empirical papers to be ultimately determining. They're always conditional, but this is rather suggestive. But so is it the case that there's actually some correspondence with theory here? Well, if we take asset pricing theory and no arbitrage asset pricing theory, you say, look, the idiosyncratic risk is not what we're worried about. We're worried about sensitivity to events, economic shocks and so on, you cannot get away from, okay? They call them common factors. So yes, indeed. And it could be that actually what accountants are doing is just screwing around being accountants with no real conveying risk, okay? Now, the fact that these numbers are actually correlated with forward betas is a little bit comforting, although, that's betas on the market portfolio, and the question where the beta on the market portfolio picks up the sensitivity to all the factors of risk, the factors involved, common risk, inflation, interest rates, and so on. Okay, so that's outstanding. You're quite right. Okay, and so actually the next part of the next part of the session here actually deals with that. So Jeremy, if there's aspects of your question are not answered when we get through this little section, okay, please jump up. Okay, so now in that little model we put up before, we had a constant discount rate, and in that residual income model, that's our MBA model. But of course, we know a constant discount rate is not consistent with no arbitrage. If interest rates are time varying, okay, stochastic. And so where you want to start now is to ask whether in fact this accounting connects to the discount character of the discount in a generalized no arbitrage asset pricing model. And the paper which is the basis for this is the Rubenstein 1976 model. Okay. Which says, which very mild assumptions, no utility assumptions, very mild assumptions, basically no arbitrage, a few other things of non-satiation and so on, and an understanding that that investors have an understanding of states and events, and the prices involved in those event states in the future. And it simply says, look, in the dividend discount model, it says price now is just the present value for the going concerns, however they have the infinite summation, the dividends are adjusted for a covariance between the dividends and what's referred a Q variable here, a random variable, which it's sometimes referred to as the kernel in asset pricing, all discounted at the risk-free rate. Okay. Now this is and this, of course, given concavity with respect concavity, then this covariance is a discount. Okay. The positive sign there goes negative. Now the Rubenstein paper, and so what we've done in the paper with Chao Jung, and I must say here, the theoretical working through of this is all due to Chao Jung, not to myself. Okay, he's the one who worked it through. It's in JE last year, where we actually tie these two accounting principles, the revenue recognition principle, and the conservative accounting for investment, expensing investments, to that covariance term. Okay. Not completely, because it ties you to the risk, but it doesn't tie you to the price of the risk, which is in that covariance term. Okay, but it ties you to the risk on which the covariance is formed, but not to the price of risk. And the price of risk is very elusive, of course, and we can't expect, I think, accounting to actually give us the price of risk, particularly as the price of risk is different for all of us. We all have a different risk premium. Okay. So that paper there, I think, is very important. An answer to Jeremy's question, that really ties in part this accounting formally to the discount rate in a general, very general, no arbitrage asset pricing model. Okay. Now that endeavor is continued in a subsequent paper where we say, look, hold it. This is not this Q variable here. It's actually just a mathematical result. There exists a Q such that price is equal to the present value of the discount rate of the expected dividends adjusted by that covariance. Okay, so it's really just a mathematical statement given the assumptions. So what you need to be practical, you need to think about what this Q variable represents, and that brings us to consumption-based asset pricing model, pricing theory, or the consumption CAPM. Okay, this is the one that runs through Cochrane's book and runs through Breeden and Litzenberg and so on. Okay, and you might say it's a premier model in asset pricing theory, and that says, look, price now, the price now is just the present value of expected dividends discounted by this M tau for each period. Okay, now I bring this up because the wonderful thing is this actually is very key to tie accounting to asset pricing, because it turns out accounting deals with consumption. Okay, so you know, we know where this comes from. Investors give up current consumption to invest in a firm in the hope of getting future consumption. Dividends are paid out from the firm, cash flows if you wish, they buy consumption. But that consumption's at risk. Those dividends are at risk, those consumption are at risk. So that's just the basic economic thinking behind the model. And of course, the specification of the discount by the mathematics of an expectation of a product of random variables, you get that this price is equal to the expected dividends discounted at the risk-free rate plus a covariance term of the covariance of dividends with this discount rate referred to as the stochastic discount factor, with that now very sensibly, intuitively, just based on the relative marginal to live consumption that you give up with the consumption, marginal to live consumption at each period t in the future, plus a impatience factor. Okay. the time. So that makes very sense of, and of course, with the concavity of the utility of consumption over consumption, this comes in negative. Okay, so everyone, I'm going through this. Maybe I shouldn't go through it. Maybe you all know this, but I just want to make sure the foundations where we're coming from here. Now, this is very strange, this covariance, because you think about Apple, Microsoft, Cisco, 30 years, no dividends. The covariance of zero with anything is not very, is zero when I went to school, okay? And so this is not very operational. And so the question is how we get this operational such that we pick up something which actually forms about a covariance, but it's not dividends. And of course, lurking in the background here is the notion that dividends are irrelevant to valuation under a M&M assumption, dividend irrelevance assumption. So here comes accounting. And it sort of hit me. I didn't realize this. Accounting links to consumption. What we do is when investors pay into the firms, giving up consumption, that creates book value, which is then taken and invested in assets. The dividends that by consumption are paid out of book value. That's actually the clean surplus relation. Book value is earnings, but reduced by any dividends. If the dividends are negative, it increases book value. If it pays out, it reduces book value. Okay. So book value is created, determined in part by dividends paid in and dividends paid out. But of course, so future book value is at risk. Think about what gives me future consumption. Future dividends, I can't pay them out unless I have book value. And that gives me my consumption. So it's the future book values that are at risk. And by the clean surplus equation over a number of periods to any t, it's just the current book values plus the earnings minus for every period up to t, up to t, minus any dividends that are distributed. So what generates future book values? Well, dividends in and out, consumption lost, consumption gained by dividends paid out, but the anything is the earnings. And so we have the notion here that earnings are at risk. Okay, and that's by accounting principles. Mm-hmm. We pay consumption given up. We add consumption given up to book values, and we add consumption paid out, dividends paid out, consumption paid out of book values. So it's book values at risk, and they're generated by earnings. And so substituting this T period clean surplus relation into into the asset, the consumption-based capital asset pricing model, we get this expression, and that's in the Penman and Zhu paper at the bottom of the paper of the bottom of the screen. Okay, Penman and Zhu. Now, one marvelous thing about this, as you work through it, I'll leave you to go to the paper, because again, I'm just giving flashcards here. I'm not going through the whole derivation. If you go through the derivation, it turns out that dividends drop out. There's no dividends in the covariance term, and dividends drop out completely. This is a valuation that is irrelevant, dividend irrelevant, and consistent with M&M. And that's wonderful, okay? And that is a property of accounting principles, because accounting principles say dividends are paid out of book value, but dividends do not affect earnings. Accounting distinguishes the creation of value from the distribution of value. It's built into accounting principles. Now you say, well, hold it, there's dividends here. No, that just reflects that if in fact I take the dividend that paid out and I go and reinvest it, okay, I add to my price. I add to my price. So this is what's referred to come dividend earnings. And indeed, if the firm doesn't pay the dividend but reinvests it at the risk-free rate, I get more earnings. Now, but notice that those dividends are reinvested at the risk-free rate. Dividends, I get the dividends. I have consumption, but I can preserve that. I don't have to consume now. I can preserve that consumption by investing in the risk-free asset. And that preserves my consumption. And that's, of course, consistent with M&M. Dividends don't matter. You don't have to consume when you get the dividends. You can change your timing of consumption relative to the dividends by, if you don't want the dividends, just go invest in the risk-free asset, and that'll conserve your consumption. That earnings are obviously clearly generated by production, investment activities, and trading with customers. Okay, to have a much formal economic-based representation of the earnings is very important. As you say, not many people are doing that. Okay, I think that's going to be very important. However, I don't see there's a problem here. What's going on here, the process is a measurement process. So I don't necessarily see this as a statistical number, which is a drawing on future earnings. I'm sitting here saying is, hey, what's earnings going to be next period? What customers are they going to get? And what are the expenses? What's going to show up in the financial statements? And what shows up in the financial statements by the clean surplus relation over a long horizon gives you the value. So all I've got here is a measurement process. Okay, this is what accountants do. So what generates the customers? What generates depreciation? What generates investment? Expense investment. Yes, this has to be embedded in economics. I take that point. Okay, but actually, if I got that economics, and we've got to be very careful here, that economics, what are the earnings that gives me? I'm interested in the accountant's earnings. So you were saying, look, you see these low R-squareds of returns on earnings. In my mind, they should be low R-squareds. That is, the market is speculating about future earnings 5 years ahead, and that changes prices. But the accountant says, I'm not recognizing it now. I'm waiting until I get realization. And so there's got to be a low R-squared. Contrary to the typical notion that, hey, accounting lags the prices, I think under accounting principles, these accounting principles for revealing risk, that actually accounting does lag earnings, and so you should not get perfect R-squared. You get perfect R-squared with fair value accounting, if in fact that's feasible. But in answer to your point, yes, we need to get the underlying model here. Okay. Now, someone who does that is Lou Jung and his colleagues at Ohio State, because they've produced a production investment-based asset pricing model. So you have an expectation that the discount of the earnings here is at the risk-free rate. Okay, because the idea is the earnings, once they get the earnings, are released from risk, but you've got a discount in case you don't get it. And this is just your expectation. Now, that expectation may be developed by going in, as we teach in our classes. You just can't handle the classes. You've got to understand the business, the production of the business, the marketing of the business, and you translate that into valuation terms through the accounting. So you forecast cash flows to infinity, okay, or for 100 years, and earnings and book it for 100 years, you'll get pretty much the same thing, okay? But, I don't know about you, forecasting anything more than 3 or 4 or 5 years gives me serious psychological problems. The accounting is only going to be informative if, in fact, it brings that future forward. So, for an example, if, in fact, I have cash accounting, which you're talking about, for pensions, I've got to forecast the payout to the pension holders 30 years on when they retire. Or I can do accrual accounting and say, here's now the wages equivalent now of a pension promise. I'll put that in the income statement, and I'll put a pension liability on the balance sheet. You see, that is potentially doing something. That's helping the investor. What about the firm that actually doesn't pay dividends? Berkshire Hathaway. Well, maybe you look at the income statement and the balance sheet, it might help you, rather than forecasting the dividend, which they say they're never going to pay. That I think is the key to getting hold of this accounting, which is practical for investors, because ultimately we are limited rationality period. We can think about the next few years, but man, thinking about 2075 is a little bit. In the long run, we're all dead. Mm-hmm. So, okay. They're very good. They're very good questions. But just note that equivalence. That people come with their equivalence. What do you? Well, I started off by saying there's nothing put on the table in that residual income over an infinite horizon because random numbers satisfy. Okay, but you know, practically we can't work with infinite horizon valuation. And so we need accounting and I believe that is the essential feature of accounting. We can work with discounted cash flows for a bond because it's terminal. We can even work with a project because we have a bit of an estimate of the life of the project. It's terminal. But for a going concern, you've got huge practical problems. I feel, my strong feeling, and at Columbia we always had this feeling, theory is so important. You're going to stop Penman from mumbling, okay? Theory is very important, and getting that theory on the table is very important. And I've got a lot to learn about it. Fortunately, I have some cohorts, particularly Chow Jung has been very, very helpful. But I can't stress how important it is, because these bloody regressions that get run in these workshops, I mean, it just drives you crazy, okay? So please, if you want to interact on this, please do. And thank you very much, Jeremy, and for all of you for your attention.